Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites JugglingDynamite.com and VenablePark.com. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, has the Treasury market called the Fed's bluff after they raised rates a whole 0.25%?
Yeah, so the U.S. Fed raised rates 0.25 yesterday and intimated they would plan to do so 6 more times in 2022. They also intimated they want to start quantitative tapering of reducing their nearly $9 trillion balance sheet of bonds. They haven't hiked rates since 2018, so this was a step in a long climb that they see before them. At the same time, the Bank of England followed suit this morning with a hike as well. That's their third 0.25 hike, so they're now at 0.75, where the U.S. Fed is in the 0.25 to 0.5 range. The Bank of Canada, of course, has already hiked and stopped its quantitative buying as quantitative easing or buying of bonds already. So the ECB is the only one that hasn't actually hiked yet, although they're talking a big talk and saying they too should look to reduce their balance sheet. But I mean, they haven't hiked rates since 2011, since the European financial crisis blew up back then. So that's over a decade now since they made any effort to tighten. So this goes back to the problem with this cycle is that, the central banks have been so easy and so reactionary to falling asset prices for the past decade that every time there was the slightest, mean reversion starting, they stepped in to try and reflate everything. And we now have a mess on our hands of grand proportions, because when the economy was reviving last year, of course, on all the federal stimulus from the governments and the central bank injections and all the borrowing and buying of housing and durable goods that was going on, it really inflated that sector of the economy, and we had a rebound sharply from the 2020 recession, which was the shortest recession that we'd ever had. So we got this really violent rebound in consumption based on all these prods of debt creation. But even as that was happening, and even as asset prices went parabolic and housing inflated more than 30% and commodities went off the charts, central banks still didn't move at that point to hike. And that was a policy error, because now they come to this point where we have, these additional adjutants, which of course is the invasion of the Ukraine, which has spiked oil prices astronomically in the last year to date, on top of food prices. It's, Russia and the Ukraine being a major breadbasket for the world, so there's a big impact to grains. There's all sorts of disruptions happening. On top of that, we have this next strain of BA2 coming in China, where they have the highest incidence of spread that they've had since the beginning of the pandemic by far. Hong Kong, again, the highest death rate they've seen, and of course that's transmitting to other places in the world as we speak. So you have this sort of confluence of every possible nightmare that could happen. Life's full of risk. I say this all the time. We have no idea what's coming for us. All we can do is really manage our risk exposure and our behaviors in advance of the surprises that hit, so that you're as stable and resilient as possible. And of course, in this scenario, the policy moves have been all to undermine our stability and strength heading into this, as I say, confluence of a bunch of negative factors. So really what's happening is we had a slowing economy in the world already. We had, as I said, this 7% annualized growth rate in the fourth quarter that was really unusual and the highest we'd seen in a long time. And now we're getting a big fall off coming into the first quarter. The latest Atlanta Fed nowcast that's out today on U.S. growth has it at just over 1%, as I said, down from 7% in the fourth quarter. So we have a rate of change here that's really extremely extreme and going in the wrong direction for growth and demand in the world. At the same time that you have this shock in energy prices, and historically when you've had this level of shock in fossil fuel prices, because we are so heavily dependent on them, you get a recession. So we already had the prospects of a recession happening in 2022 before we ever had any hikes coming from the central banks. And of course, now that the world has become so addicted to this easy money, and things like the housing market have been so infected with the speculation, the inflows of capital, the oligarch money, the money laundering, it's just been a complete mess. And that's really cost us plenty because it has inflated our cost of living exceptionally. At the same time that real wages have actually been negative now. We're negative in the recent data and have been for the past many months. So the cost of living is crimping our ability to spend. We're seeing that consumer discretionary stocks have fallen over 20% in the past few months. Global earnings revisions are negative. We've seen that. That's the first time that's happened since 2020 when we had the 2020 recession. So basically the bond market, has listened to the central banks saber rattling, talking the big talk, that they want to really get ahead of this inflationary impulse. Of course, they're way behind the inflationary impulse for the reasons that I expressed, that they missed their calling and their opportunity to start tightening monetary policy when the economy was really overheating last year. They really come into this flat-footed and way behind, and now desperately wanting to have some rate cutting ability. Their go-to over the years has been whenever there's an economic downturn, whenever there's a sell-off, a bear market in risk assets, that they look to loosen financial conditions and use that as a way to revive credit uptake again. But of course, as I say, coming into this massive rate of change to the negative, they're still, barely above zero, and still sitting there with these really bloated balance sheets full of assets they've bought and never ran down in the last decade. So all that together means that they are really out of tools. All they've got is talk, and they've got a lot of political pressure. These are election years in the United States coming into the midterms. We've got elections coming up in provincial elections in Canada. There's a lot of pressure to try and do something to help the crimp in the household spending ability. And so that is, turning to central banks and saying we should be hiking rates. And they're saying, yes, coming right up, master, we'll hike rates. Of course, they have so little room to move here because of all the other negative impacts that I've already said. So it's not just about, the economic outlook looking pretty negative. Recessionary impacts were, 75% chance of a recession priced into the bond market before they did any hikes at all yesterday. And at the same time, the 2s and 10s, which is another economically indicative measure, the bond market typically reflects the prospects of coming recession. And when the 2 and 10-year yield curve inverts, where the yields on the 10-year become lower than the 2-year, it suggests you've got 100% probability of recession. So the other problem for asset markets is that and as I think I mentioned yesterday, when the stocks rallied off of the news that central banks were finally hiking, the 10 and 2 spread actually slumped to a new cycle low at 0.2, so barely above zero. So all of this really just confirming, as I said, that the bond market, heard all the central bank talk, has priced in all these hikes that they've, basically imagined they'll be able to make in this fantasy land they live in where the economy is doing great. If you heard Chair Powell yesterday, he was talking up the economy being robust and, consumer balance sheets being strong and all that without any regard for the extreme leverage, the, again, lack of cash savings, the weak wage gains, that the negative real wage gains, that diminishing ability to spend on other sectors of the economy because of the shock to food, price, and shelter. So all of these things have really undermined the strength of the economy, and the bond market is just saying, fine, we've priced this in, but in doing so, you see the cost of capital has already risen sharply. So in the past few months, as the bond market has repriced, bonds have sold off across all credits, including corporate debt. That means that corporate spreads, the high yield spreads on corporate debt relative to treasury bonds has increased 400 basis points. And again, in the past, that's the highest since the last recession in December of 2020. So what that tells you is that the cost of capital for companies borrowing money, and we know that companies have been borrowing a ton of money as a way to sustain themselves. The amount of zombie companies that can only sustain themselves by borrowing and borrowing and borrowing because they don't have enough free cash flow to actually cover their expenditures has been at an all-time record high in the past couple of years. And so now we're talking about their cost of capital leaping quickly in the past few months. At the same time as, things like mortgage rates, the 30-year mortgage rate in the United States, which is the most popular term, spiked about 4% at the same time that the price of gas per gallon jumped above $4 a barrel in the United States. So all those things really set up for this big downturn in demand, in consumption ability, in economic output, in profit margins. And that's why I say that because that's already happened, now the central banks won't be able to hike nearly as much as they hoped, because the economy just won't take it. And also, as I've mentioned, in the past, we are already in the midst of a bear market in stock markets and corporate debt markets, which began some many months ago.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, will China ever be able to meet the global demand for its products, or will we even be able to afford those products if inflation continues at this rate?
Well, I think that, in the past, every time we've seen this kind of a leap in the cost structure in the world and the inflation rate, it's been a top in the commodities cycle, because high prices are a cure for high prices and they suppress demand. At the same time, China's got so much problems at home because of its own debt bubble and its own inflated housing market, which has been imploding since last fall. Don't forget, with the Evergrande default, we've seen a whole bunch of defaults in the property sector. So recently, the central bank, who was talking about the insistence on increasing common prosperity and, trying to redistribute funds from a few pockets of super wealthy people into more of a egalitarian distribution through their households and economies. They've been trying to do that as a goal in the past year. They blinked again recently because they have so much fallout coming in their own economy. And they've gone back to trying to ease rates. This is what I'm speaking of, that the central banks and the governments talk a good game, but until everything starts to wobble and asset prices start to fall and the housing market starts to fall apart, which is what's happened in China. And so they've doubled down on this idea of, okay, fine, we'll backstop, property developers again. We'll try and step in to ease conditions again, to try and make people borrow money again. But ultimately, they are really looking to exports as a way to sustain their economic momentum again because they're having so much trouble at home. And at the same time, they've been hit with this new iteration of the COVID virus, which has got some 90 million people on lockdown in a bunch of their major ports. So this is, a really delicate balance that they have. We know that they, as I say, they want to export a lot of stuff because they need external demand to give them cash flow to service their needs inside the country domestically. But at the same time, we've had this big surge in spending already in the capital goods sector, much of which comes from, Asian exporters. They don't provide us typically with services. They provide us with goods, and that's what the North American and European economies have consumed with wild abandon during the pandemic was all this goods. We also know that the stores of inventory have been largely rebuilt in the West. So there's been a lot of stockpiling, a lot of double and triple ordering, a lot lot of people buying up warehousing spaces and, manufacturers. And we saw, for example, some of the New York Fed Empire Manufacturing number actually was negative in the recent reading this week. So I think that we've rebuilt a lot of the stores of supplies and inventories which were diminished during the pandemic, and just at the time that consumers are wanting to buy less stuff and having the ability to buy less stuff. So I think that China's in for a challenging time because they're hoping that we're going to continue to borrow and spend at a time when we've already pretty much done that to the extent of our ability for some time here, until we get debt paid down again and until some of these durable goods need to be replaced. Because they have a lasting period of years, not months. And if anything, there's more of an interest to moving back to the services sector, which, as I say, is more domestically produced here and not imported from places like Asia. So all of that really means that China's in a downturn in its global growth, in its growth projection as well, at a severe rate of change. And that is, looking more and more grim as you look out a year and two from now. And this negative credit impulse in the world, as the cost of capital has gone up and the ability to borrow and buy has gone down, is likely to also be a challenge for the other major economies. For China, Germany's back in recession. Japan is seeing a lot of a negative impact as well. So there's really no real bright spots here. On top of that, you've got supply constraints, of course, as I mentioned, with the Ukraine situation, where the fossil fuels being sent out of Russia are being restricted, as well as the prospects of losing a lot of the grain that's produced in that area, which creates huge food inflations in places like Africa and many parts of the world that depend on it. So you've got this crunch in the agricultural sector, which is really hitting people right at its foundation. Our ability to eat, to transport ourselves, to heat housing, to heat our homes, that's really the bulk of where most people's income or spending it goes, and it's at this having a big shock. So I just think that, all these factors together suggest that we're going to have a period of very challenging economic growth coming forth in the next year, just as I say, as everyone's expecting central banks to do something about inflation. Ultimately, they won't be able to do anything about inflation. Their opportunity to do that would have been to have stepped in a year ago and, slow the amount of speculation that was going on in the commodity space and housing market, which really artificially inflated a lot of these costs of goods well before the Ukraine situation happened. So because they didn't do that, they set us up for this really difficult period during the shock, which ultimately will crush demand, crush spending, crush economic growth and corporate profits. And then at the same time, we came into this at the highest asset valuation. So again, stocks pricing in this extraordinarily high earnings growth forecast because of all the speculation that went on. And I've been writing about this for some time, as you know, Jim, on the blog, talking about everyone got so enamored of many of these stocks that were hot during the pandemic, the Pelotons, the Zooms, the DocuSigns, all these technologies that were very widely in demand during the lockdown phase and really helped us to, conduct our business, to keep fit. And that's all very well and good. The problem was the pricing, right? The problem was the valuations that were being put on them, because people just hear a story and don't pay any attention to the price being paid. And this is a classic study that we saw across the board. It's similar to what we saw in 2000 when the internet was changing the world, and it was. But people were paying, 10 times sales for some of these companies, which never is a good idea. And so multiples, the valuations that people were paying for these earnings, for sales, revenue, was so overdone that they were always going to be a terrible investment prospect or investment return, regardless of the fact that they were indeed these really world-changing technologies. And so that's what set up the things like the NASDAQ market as being so extremely vulnerable. And indeed, it's already come off 20%, just over, until it rallied the last couple of days from its November high. And we're seeing that across the board. So now as you know, Apple has come off less than the broad benchmark, but it's been the one sort of holding up the whole bucket, so to speak. And as soon as you see, you know, further weakness in that as this bear market continues, which I think it's going to, notwithstanding big rally days. Don't forget these big triple swings, you know, 400 points, 500 points, up and down, up and down. We've seen something like 13 of those since February, and that all very typical of bear markets, not bull markets. So that extreme volatility and the big spike in VIX all suggests we're going to see a compression in these valuations. So as earnings are coming down, the price people are prepared to pay for those earnings is also coming off. So I think that all really sets up, again, there'll be extraordinary opportunity on the other side of this, which is the exciting part of it, but only for those people that have negatively correlated assets. So in other words, to the extent everyone's holding, you know, a whole bunch of stocks here, and in Canada, you know, our market has held up longer because we have this high concentration in the late cycles, which is the fossil fuels and financials, right, which have been the benefactor of these easy money policies and speculative flows in the past couple of years. But because we have a high concentration in those two sectors, our TSX holds up longer than other markets like the NASDAQ or like the S&P, and we've seen that this cycle. But then, as we have to be aware, those are also highly cyclical. So as soon as the whole thing actually starts to tumble again, you're going to see a sell-off in those things as the demand comes down for things like fossil fuels again, as credit markets begin to have more stress. And that's when the TSX will really participate to the downside as well. And that's typical. We also have seen that the Canadian dollar, the loonie, has, you know, peaked in May against the U.S. dollar. So even as the price of oil spiked in the past few months, the loonie did not go with it. That's, again, another vote of non-confidence in the Canadian economy, in the sense that we've become so tethered to this housing bubble story much more than to any productivity gains, that the world looks at us now as, you know, becoming more precarious in this particular set of facts. So I think that, you know, the good news here is that we need this to happen, because we can't have, you know, these escalating asset prices and unaffordable food and energy and housing forever, obviously, and there's great pain in this for many people. The flip side is that lower prices will be the solution to this whole mess, and although it'll be painful to get from here to there, that'll be great opportunity for people that have cash and financial discipline on the other side of it, and that's the silver lining.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim. My
guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.